Hi everyone, welcome to the 14th episode of Insights in Action with IAB South Africa and Kantar AME. It's a fabulous day here in Cape Town. I hope you're all doing well wherever you are in the world. And we're still letting a few people into the waiting room, but we'd like to get started as we know we all have a busy Wednesday ahead of us and we've got a session jam-packed with insights this morning. A big thank you to the agencies, publishers, and brands who are online with us this morning to hear smart, actionable, and motivating insights to help you make better digital decisions in your business and beyond. We hope you're keeping safe, we hope you're keeping sane, and that today adds valuable insights to help you on our journey ahead together. Today is, as I mentioned, our 14th episode, and today we're discussing creating brand value in the digital age. These learnings from today are from the Kantar BrandZ Top 30 Most Valuable South African Brands report for 2020. And today we include insights from FNB, an IAB member, which topped this year's ranking for the first time with a brand value of $2.8 billion. And we're going to learn how they have built the brand in such a way as to stay relevant through digitization and a focus on customer health during economic downturn, as well as how FNB continues to be perceived as different in a category that has become highly competitive and inundated with innovation challenges. We're just going to let a few more people in this morning. While we're doing that, just a bit of online etiquette this morning on our webinar. So you will have noticed as you came in that your microphone will be on mute. That is just to control the noise so we can hear all the fantastic insights that Stina and Natalie and Raj are going to be sharing with us this morning. If you can also keep your video off, that just helps us control the screen resolution both on the upward and downward reception. So if you can keep your video off, that would be fantastic. And then just a final note, we are going to have a Q&A, questions and answers at the end of the session. That'll be at about, we either will do it at 9:30 or save all our questions till the end after Raj has spoken at about 9:45. So please keep your questions coming, use the chat. It is going to be on private mode so we don't get distracted with all the amazing insights and learnings from the Kantar team and from FNB. But I'll pop a few reminders through as the session progresses to remind you to share those questions so we can gain as many insights as a team as possible. Right, with no further delay, I'm going to introduce you to our two speakers and our guest. I'm introducing them all up front so that we don't disrupt the flow of the insights this morning. So Natalie Otte will be speaking first. She is the head of Kantar Insights in Johannesburg and Chief Client Officer for Kantar South Africa. Natalie is passionate about helping clients grow great brands by capitalizing on data and human insight to capitalizing on data and human insight to increase their market share and profitability. Certainly two key goals for anyway towards the end of the year. By partnering with clients, Natalie believes that meaningful research can influence brand strategy, marketing communication, and creative development decisions, which will all ensure the greatest impact on your brand and business growth. Natalie has over 16 years of experience in research and has worked extensively on brand health, media, and creative development projects for various clients, including industries such as banking, telecommunications, FMCG, and alcohol. Then we are joined again by Stina van Rooyen. Stina, as you may remember, if you were part of our Insights in Action sessions earlier this year in May, Stina spoke in one of our second sessions. Stina has over 22 years of market research experience and she has a passion for brands and advertising and a curiosity for understanding consumer thinking. Stina has experience across numerous financial services, FMCG and alcohol category brands. Stina has been championing brand guidance systems and brand strategy for the South African business for the past 2 years. So that's Team Kantar, who will be speaking today. And then we welcome later on in the session, Raj Makanjee from FNB. Raj is the CEO of Retail and Private Banking and the FirstRand Chief Digital Officer. A quick bio for Raj. We had to shorten it. It's an amazing, amazing CV. I think you better check him out on LinkedIn. Just an incredible set of experience. Raj is a qualified chartered accountant and joined FNB in July 2008 as CEO of Core Banking Solutions. And in addition to his CBS responsibilities, he was also appointed the FNB Chief IT Officer, or the CIO, assuming responsibility of the bank's overall IT strategy, architecture, governance, and technology leadership. More recently, Raj assumed CEO role for the consumer segment and was appointed to the FirstRand Strategic Committee in mid-2018 in the capacity of Chief Digital Officer. And in this role, Raj is responsible for optimizing the group's platform capability, particularly focusing on customer centricity, integrated financial services, platform modernization, and the digitization of processes. Now that is a fantastic CV, and we look forward to welcoming you later in the session, Raj. But with no further ado, I'm going to hand over to Natalie, who will be kicking off with our session this morning. Thank you, Natalie.
Thanks, Paula, and good morning to everybody. Thank you for having us today. Just in terms of the flow for today, I am going to talk to you a little bit about BrandZ and what it's all about and how we do it, and then stop on some key insights on the global top 10 most valuable brands, and then we'll hone into the top 30 most valuable brands in South Africa, and I'll just give you some context around that, and then we'll hand over to Stina, who will look at some key themes and insights that the top 30 ranking this year has brought us. Now I hope the slide is going to move. There we go. Okay, so as I said, what is BrandZ? So BrandZ is actually currently the largest brand building and equity platform in the world. And it was actually established over 22 years ago by Kantar. It started out as a way for Kantar to track what people know, feel, and think about brands, and for us to establish what makes some brands more successful and stronger than others. It was only later in 2006 that we realized we are sitting on such a wealth of knowledge and information that we could use this to evaluate brands and actually be able to tell brands what they are worth. So it started out as a global valuation, but today we do individual country brand rankings and valuations as well across 18 countries, and that now includes South Africa as well for the third year in a row. So with 3.8 million consumer interviews across almost 18,000 brands, in 512 categories across 51 markets, we have 5.3 billion data points. So we know a little bit of something about what makes brands tick. But today, BrandZ is one of the most trusted brand valuation platforms in the world. And we have a lot of established financial institutions and influential decision makers that use BrandZ. And actually the BrandZ valuations are currently fed directly into the Bloomberg terminals. So this is one of our most loved charts. And for those of you who've ever attended some of Kantar's brand presentations, you'll recognize this chart. But it just shows the long-term evidence as to why investing and nurturing strong brands does pay off. So you can see over the last 14 years how the BrandZ portfolio consistently outperforms other portfolios like the S&P 500 as well as the MSCI index. And if we look back at the 2008 recession and how the BrandZ portfolio also took some really hard strain, but managed to return to growth in less than a year when it took the other portfolios 4 to 5 years to return to growth. It really does demonstrate the resilience of strong brands and their ability to bounce back in tough times and therefore protect businesses against risk. And even now in 2020, we are seeing that during the pandemic, if you look at how the BrandZ brands are already returning to growth this year after seeing significant declines. How do we do it? How do we do the valuations? So we have a group, first of all, we have a group of very clever people who look at the financials of companies and tease out the proportion of that value that can be attributed to the brand. They consider both current and projected performance created by that brand. And that information comes from Bloomberg. Then the special ingredient which makes the BrandZ valuations different is the consumer element that we build in, called the brand contribution. And this is the brand's ability to attract loyal consumers over and over again, as well as the ability to command a premium. And this comes straight from the BrandZ survey of actual consumers and their thoughts, feelings, perceptions, and behavior around brands. We then use this as a multiplier to calculate the overall value of the brand. Let's have a quick look at the top 10 global most valuable brands at the moment. So you'll see remaining at number 1 is Amazon. This year with 32% growth in value, sitting at $416 billion. Amazon is followed by Apple, Microsoft, Google, and Visa to make up the top 5. For many years, actually, we saw Apple and Google vying for that top spot. But e-commerce and online retailers have seen significant growth in relevance and value over the last 5 years. And with Alibaba, with the likes of Alibaba now sitting at number 6. MasterCard is a new entrant this year, as we see electronic payment systems and contactless payments accelerating in growth, and especially this year with the pandemic hitting us. And then one of the interesting ones for me is McDonald's. Really the only brand left in the top 10 that we could say is a physical bricks and mortar brand, when all the other brands are really tech, digital, social. McDonald's really does stand out in that list. Speaking about McDonald's, I find it really interesting to look back throughout the years at the top 10 to see how it's changed. And you'll see back in 2006, when we started the valuations, there are only 2 brands that still remain in the top 10 14 years later, and that's Microsoft and Google. With physical brands like Coca-Cola, Toyota, Walmart, and Marlboro no longer in the top 10. And although those brands are still very strong brands, consumers have changed their purchase journeys, and digital and tech brands have taken their spots. And interestingly, you'll see a little bit later when we look at the South Africa top 30, this is what our top 30 is lacking. We currently have no local tech or digital brands coming into the fold as yet. And this is just reiterating the huge, significant growth of the tech brands that we've seen over the last 12 years, continuing to grow brand value even through the last recession as well. And so this doesn't mean that if you are in the tech, digital, and social platform category or space, brands will just continue to grow regardless. Facebook has seen quite a huge decline over the last 2 years and a further 7% decline in value this year, and actually has been steadily losing relevance on a range of brand equity measures. Facebook is seen as much less able to meet consumers' needs, especially in contrast to Netflix, which is now rated higher than Facebook on this attribute among younger consumers, but also losing amongst the older consumers. And similarly, Facebook is less well rated for being a well-designed service and for having a good range of content and services. Even Facebook's star second brand, Instagram, which has grown brand value consistently over the last 3 years, looks as though it could be eclipsed by the even faster growing global growth of TikTok, which has entered the top 100 this year at number 79, with a brand value already 41% of that of Instagram's. So even in a growth category, brands have to stay relevant and invest in brand building in order to stay ahead of the pack and continue to differentiate themselves. And interestingly, in another study, which we call Media Reactions, we also saw that new platforms, if I can move on, that new platforms such as TikTok, Instagram, and Snapchat are actually most preferred by consumers. Yet marketers seem to still be sticking to the older platforms, the older trusted platforms that they know and trust, like YouTube, Google, and therefore potentially putting at risk the fact that they're not keeping up with the times, not keeping up with the audiences. That's not moving. Just try again. There we go. So this is what I just spoke to. So you'll see consumer preferences there. Number 1, TikTok, 2, Instagram, Snapchat. But yet then there's a huge disconnect when we look at the marketer's preference, which is YouTube, Google, and Instagram. Okay. Let's take a closer look at what's happening in our top 30 in South Africa. And just a reminder that in order for brands to make it into the top 30 in the country ranking, these brands have to be born and bred in SA, which is why you won't see the likes of Facebooks and Apples in the ranking. The South African BrandZ, just for interest, is currently sitting at over 28,000 interviews for over 600 brands across 44 categories. And this is this year's top 30 most valuable brands in South Africa. FNB has moved from second place to first place this year. And as Paula has said, sitting at a value of $2.8 billion. FNB is followed by Standard Bank, Castle, Vodacom, and Nando's to make up the top 5, bearing in mind that the Castle mother brand also represents Castle Light and Milk Stout. And just a few other interesting mentions, Capitec and Clicks were the 2 brands that moved up the most in the rankings this year. Capitec up 5 places, now sitting at number 12, and Clicks up 5 places as well, sitting at number 24. And on top of that, Clicks is the only brand this year to see an increase in brand value, and that at 10%. And Clicks was also seen as the most loved brand this year. And I just find that really interesting to see how that plays out, because we know recently Clicks has had some reputation issues, and the social media has just allowed for that to accelerate and spread so fast. So we're really keen to see how that changes for Clicks in the next year. And then Nedbank has been the biggest decliner this year, dropping 5 places, now sitting at number 14. And then we have 2 newcomers, which is always very exciting, which is Flying Fish coming at number 28 and Hollard coming in at number 30. And then just one last mention, when I spoke about how we do the valuations and the importance of that brand contribution, a brand like Flying Fish and even actually Nando's would probably never have made it into the top 30 if it was only based on their financials. But because their brand contribution and their brand health is so strong in terms of what consumers think and feel, they are able to amplify their value and sit alongside the likes of FNB and Vodacom. But just again demonstrating the health of how strong brands really can bring value. So this brings our top 30 total value to $29.7 billion. Now, although this is a really huge number, just to demonstrate and put into context, I guess, room for growth, the country top 30 that ranks just ahead of South Africa is Indonesia. Their top 30 comes in at $78 billion, so more than double that of South Africa. And for a little bit more context, comparatively, our top 30 has a similar total value as the Gucci brand globally, with Gucci currently ranked at 49 in the globe at a value of $27 billion. In 2019, our top 30 had a similar value to Chanel, ranked at 31. And in 2018, Starbucks, which was ranked at 23 at that stage. So seeing how the SA top 30 value comparison to global brands has declined in ranking and value over the last 3 years, and knowing the state of the nation, I guess, going into this valuation, it is not surprising, although still very disappointing, to see that the SA top 30 value has declined by 20% in this year. This is not unique to South Africa. If we just look at a very short-term view, February against March this year, and we look at the proportionate value declines from the peak to the bottom of the trough, it is quite scary to see how the BrandZ portfolio, as all the others, have seen significant value losses in a very short space of time. But the real difference for me here is the extent of the decline. And again, just showing that the top 10 BrandZ portfolio only declining by 37% against the MSCI World Index declining by 75%. So even during significant market volatility in the current crisis, BrandZ's portfolio dipped much less than the global average. And then lastly from me, before I hand over to Stina, I just wanted to share some insights around the categories we see this year in the top 30. So for those of you who have attended the last 2 years of our rankings, banks still remain number 1 in terms of the share of value, followed by telecoms providers. This year, though, we see beer as a category sitting as the 3rd most valuable, marginally overtaking insurance, but overall financial services in South Africa still takes the lion's share with 43% of the top 30 value. Retail in general had quite a tough year, which I guess is not surprising. And we also saw the likes of Edgar's and Dis-Chem drop off the list. And then the last 15% of the value is made up of fast food, hospitals, entertainment, and energy. I'm now going to hand over to Stina to just hone in a little bit more on what kind of insights we can see from our top 30 this year to help us really think through that in terms of building stronger brands in South Africa.
Thank you, Natalie. Now let me see if I can. There we go. Thanks, Natalie. There are three strong themes from this year's result that we're going to unpack in a little bit more detail. And the first centers around the fact that South African brands lack strong equity. And I say this in the context of comparing South African brands to other countries' top 30. And as we've seen from Natalie's section, and as we've heard her point out, it seems that South African brands are not doing as well as standing their ground in tough times as the brands in the BrandZ Strong Brands portfolio. You would have seen those declines over the last 3 years. And this might be because South African brands' value are mostly built on their financial results. So she was talking earlier about that brand contribution side. And the brand contribution side is the side where you look at the relationship with consumers and demand for the brands. And that is a lot more stable and longer term than financial value and financial markets that fluctuate. So we would have seen a very strong decline in the value of our brands over that period in the financial value. And if we compare the South African top 30 results to those of other top 30 developing markets, we see that in our top 30, we have only 4 brands who get their strength from brand contribution. Whereas for Indonesia and for India, there are 17 and 12 brands, respectively, that score a 4 or a 5 out of 5 on brand contribution. And also, if we look at the average brand contribution scores, you'll see that South Africa sits at an average of 2 out of 5, while India and Indonesia sit at 3.4 and 3.2 respectively. So it indicates that we rely much more heavily on the financial contribution than on equity, creating equity for the brand. We can see this again if we look at the most resilient brands. So most of the brands lost value this year. If we compare the most resilient brands in the turquoise to the least resilient brands, we can see that the brands that were more resilient actually performed very well on our 3 validated measures of meaningful, different, and salient. And those are the measures that we've identified as helping brands grow. If we look at those brands that showed a bigger decline in value, they still come to mind quite easily, which is what salience is. The problem is that brands that are the least resilient really struggle to create a sense of difference. And if you're not different, it makes it easy for consumers to substitute you. So looking at the 3 most resilient brands in our top 30, they all perform very well against being meaningful, salient, and different. You can see that Pick n Pay, in fact, has the highest salience. Clicks ended up having the highest meaning. And Capitec actually also had the second highest meaning. So these brands have done very well to create meaningful difference. If we look at what these numbers look like for FNB, we can see that they've had a less notable decline, and we compare them to the #1 brand from last year, Standard Bank. And for FNB, they've managed to grow both meaning and difference since 2019. And those 2 solid building blocks support a huge increase in the brand's ability to come to mind quickly, or what we call salience. Now, brand salience has actually become a lot more important during the pandemic, because we've seen a strong shift to digital commerce in many different countries. And that means an increasing reliance on digital search. So many companies have doubled down on buying specific search terms related to brand and category. But the biggest opportunity is still if you can actually make your brand the one people search for by name. And if search is to make the sale, your brand needs to be the one that comes to mind first. So people search for it by name, or failing that, if they see the brand name in search result, it will trigger an instinctive positive reaction. And at Kantar, we know there's a direct relationship between share of search and brand salience. The higher a brand salience is, the more likely it is to be searched for by name. And raising salience against specific needs might therefore open up growth opportunities for a brand. This brings us to the next key theme, which states that difference is key. And this is especially so in times when consumers are re-evaluating their options and they're becoming a lot more price sensitive. We know that even when people do choose on price, the evidence suggests that they will still pay a bit more for a meaningfully different brand. And even in times of recession, they don't automatically choose the very cheapest brand. On this chart, it shows the difference between brands that charge less and those that charge more from our BrandZ database, the global database, and how they are perceived. And we can see that the biggest difference is difference in the middle. Difference gives us a reason to choose, and it also helps a brand justify a slightly higher price point. In the local BrandZ for South Africa, in the top 30, Woolworths has the highest difference. And they demonstrate this point very well because you can see they've got the highest score on difference, but they also have the highest ranking on being worth more than it costs. So I think nobody can argue that Woolworths is not a value brand, but their difference justifies them being worth more what they cost. And then turning to a global example of TikTok that Natalie pointed out last year, it looked like they had an exponential growth. But TikTok has actually been in the top 100 before. They dropped out and they made a strong comeback. And that is because they leveraged their growth from difference. And if we just look back a year ago to 2019, you can see that this, as researchers, we love plots. I have to throw a plot at you. So we're looking at meaningful across the bottom and difference across the top. So this brand started out as a very different brand, but it lacked meaning and it lacked salience. So they actually grew from a small specialist brand to a real star brand and now challenging WeChat, because what they did was they had took that difference that they had created, they added meaning or relevance to consumers to it, and then they amplified it. And they moved into this very strong position that we're seeing in 2020. The last point is around purpose and the fact that purposeful brands grow at a much faster rate. We actually have a very simple purpose metric at Kantar. We ask consumers which brands are trying to make people's lives better. And we can look at the long-term impact of a strong association with a purposeful positioning and see that in this analysis from BrandZ's top 100 most valuable brands, and we did this over a 12-year period, value growth among brands with a high brand purpose score was more than double that of those with an average or a weaker association. In terms of how to influence perceptions of purpose, we know that purpose shows a particularly good relationship with responsibility, which itself underpins perceptions of a brand's corporate reputation. And at Kantar, we did some work recently between BrandZ and Oxford University's Said Business School. And they found that perceptions of responsibility are now much more important to consumers than they were 10 years ago. Responsibility breaks down in 4 key areas. The two most important are responsibility towards the environment and society in general. And we also saw this in the Kantar COVID barometer, where 90% of South Africans said that people want brands to take meaningful action during times of crisis. Two good examples are Woolworths and Pick n Pay. So Woolworths took top spot for environmental responsibility and Pick n Pay for social responsibility. And if we look at FNB specifically, FNB has gone up 4 index points, and it is also represented in the top 5 most responsible brands. Knowing that a company acts well and is doing the right thing is another emotional component that helps us choose brands, help us see that brands are trusted, and it reduces the stress of brand choice. So that is it. South African brands seem to have a lot of work to do to enforce their brand equity and to create better equity. And we have to remember that salience alone is not enough to save you. You have to invest to come to mind quickly, but you also have to create difference, because difference helps people choose you. It is the point of difference that you need to amplify into salience, and that helps justify paying the price asked. And lastly, purposeful brands have become so much more important, especially accelerated by COVID. And now is the time to find your purpose and see what you can do to support or to lead your brand with purpose. So Paula, I'm not sure if Raj is on the call yet.
Brilliant. Thanks, Stina. We do have 2 numbers that have joined us. So Raj, if you're on the line, if you can unmute yourself and just say hi. Otherwise, I've just got a couple of questions I can kick off with in the meantime. Let's just see. Well, while we're just sorting that out, you know, Stina, when you presented earlier and you speak about these 3 factors that influence a brand's ability to stay relevant and to have market share, you know, I think it's, if I can get them right, I should by now, sort of salience, differentiation, and purpose. Have you noticed that, I mean, you've said that purposefulness obviously has increased substantially over the last 10 years in terms of a brand's relevance and to stay top of mind and keep market share. But during COVID, would you say that that's increased over the last 6 months, that that's increased even more? Or in this talk, you speak specifically to differentiation and, you know, in terms of BrandZ, that's the critical factor for South African brands at the moment. I don't know if you can comment on that.
Yeah. So I think purpose has become a lot more important, especially, like I said, over the last 10 years and during COVID. And we saw many attempts, I think artificial attempts, at just creating purpose around brands, and brands saying, we support you, we're here for you. Consumers can see through artificial purpose very quickly. You need to be authentic when you create purpose. And purpose doesn't always need to be something with a big P. You don't need to save the entire world. Like I said, we look at purpose as just making people's lives better. And in COVID, people said brands should focus on the everyday help that they can give us. And I think it's going to be interesting to see how brands leverage purpose going forward. If they're going to really stick to authentic purpose, make it part of their brand premise, and they can create differentiation through purpose as well. Or are they just going, you know, to be fly-by-night to use it in campaigns when it was relevant to consumers and top of mind? Absolutely.
Okay. And then I also noticed, obviously, the financial brands have sort of been dominating the BrandZ sort of top 3, and now we've got beer as a new category. Would you say that the timing of the 2020 report has anything to do over, you know, COVID's switching on and off of alcohol consumption over the last sort of 6 months, or is that not related at all? What puts beer suddenly in the mix?
So beer was in the mix last year. It grew this year because we added flying fish to the mix. Okay. But the field work for this was actually conducted January, February, and beer was actually, the field work for beer was conducted before it was banned. Okay. So the brand contribution scores for beer are actually really high. So for Castle, it is a 4 out of 5. It's one of those brands that did really, really well. Whereas for financial institutions, they struggle to get that brand contribution and consumer buy-in into the brands. So I think there's a lot of work, although financial institutions are financially strong, for them to really develop that resonance and the demand from consumers as brands and as, I think, approachable brands.
Right. And then in terms of brand contribution, you mentioned that South Africa sort of scores on the lower half of I think it's the scores out of 5, whereas sort of our neighbors are sort of in the higher 3 to 3.5 points. And you mentioned that link was directly almost around the resilient brands in terms of their ability to maybe be on the top end of that score. Are there any other key insights that you have that we could take from the other countries that could help brands here in terms of us upweighting the brand contribution score? I know you shared a few in your presentation already, but that just really stood out for me.
Yeah, so I think what we've seen over the last 3 years for South Africa, when we look at all of the key measures around brand equity, is that our key measures around brand equity has slipped. So when we look at something like purpose, especially innovation, so this year we didn't even award, we usually have an award for innovation. And South Africa sits right at the bottom if we compare ourselves to other countries in terms of innovation. And now that's not necessarily investing a lot of money in R&D. It can also be perceived innovation, things that you tell people about yourself that you've never done. We seem to not be very good at supporting our brands and getting the message across and creating those lasting memories for consumers so they have an affinity for our brand. And I think that is one of the biggest learnings. If we look at all of the other countries, country rankings, that when we look at meaningful difference, salience, purpose, trust, that South Africa is sitting at the bottom in terms of affinity, love for our brands. So I think just overall, the message there is that we need to invest in our brands and we need to build our brands.
Fantastic. And I think no better segue into introducing Raj, who's on the line. Hopefully the IT technical wizards are with us today. So Raj, can you hear us? Are you able to shout out?
Can you unmute him, Paula?
Let's have a look here. I've got 2 numbers here, so I'm just asking both to unmute. Let's see who we can.
Yes, please.
But the power would lie on their side. Yeah, so it's definitely those 2 numbers. Yes, Raj?
Hi, good morning. Can you hear me?
Morning. Yes.
Yeah.
Right. Good morning, and apologies for the technical challenges. I'm actually at work and we've blocked Zoom, so I'm coming in via WhatsApp, and I think so I'm glad we were able to connect, and thanks very much for the opportunity to talk to your forum. Is there any introductions you want to make, or can I just go?
Thanks, Raj. We did share your incredible CV earlier today, earlier in the session, so you're more than welcome to go ahead. We're very excited to hear some insights in terms of creating brand value in this digital age, and just how FNB has succeeded in those spaces from your portfolio.
Great, thanks very much. And firstly, I think just thank you to BrandZ and IAB SA Kantar for the recognition. We're truly humbled for being recognized as South Africa's most valuable brand, and to some extent it sort of brings our real health messaging that we have been using in the market over the COVID challenges we've all faced. It makes it real because it acknowledges what we're trying to do. And I mean, I too just want to also then thank all our customers and employees that actually make this happen. So from my perspective, I mean, just quickly, as you said, you mentioned my CV. I effectively have two roles in FirstRand. I look after retail and private banking activity across FNB and RMB, as well as I oversee the digitization of FirstRand across all of our franchises, FNB, Westbank, Direct Access, RMB, as well as our portfolios in other countries that we are present. So in terms of, insights in action and how it helps to build brand value, to your question, I mean, I suppose the key messages that I'd like to leave is that, we think it's something that happens over a long period, and at the heart of our clients and employees' experience, the brand is fundamentally our belief that culture is a key factor in determining how our clients experience us, because, even though digitization is at the heart of our strategy, end of the day, people is still what makes the business, and how our clients experience the bank is through our people, and therefore the culture that we try to emulate in the organization around, own the business as if it is your own. When the founders created the business, they had this concept called owner-manager culture, which effectively means we take the 30,000 plus employees that make up FNB and de-aggregate that into multiple business units, all operating with a mandate to solve specific customer needs and working together to ensure we're winning in the minds and the hearts of our customers. And by implication, it also means we're very much a bottom-up culture rather than a top-down culture. We don't, make decisions from the executive offices of FirstRand or FNB. We create a framework. Yes, we are a regulated entity, but we create a framework and an environment where people are encouraged to take decisions, to innovate, to understand what is working, what isn't working. The benefit we have of being in the business of banking is, end of the day, as individuals and as businesses, we all experience banking ourselves, and we're able to then figure out how do we make sure the experiences we're going through are what we would like to have our customers go through, and that comes through in how we have this culture of innovation and making sure people experience our own offerings in terms of what we then put out in the market. So those would be one of the key dimensions of why we believe we are able to achieve what we have. The next thing is this important thing of client centricity. I mean, the challenge, I suppose, for banks and for many organizations that operate in the South African economy is this dimension of product push, build the products and they will come, as opposed to, truly and being passionate about understanding customer needs, both short-term, medium-term, and long-term needs, and repositioning our offerings to ensure that we are truly client-centric and being able to respond to the needs of clients, both in terms of short-term and medium and long-term needs. And very important there is we want to be relevant across the full spectrum of the South African economy, from the informally underbanked client that is operating on one of our 7 million e-wallets, all the way to ultra high net worth clients operating in the private bank, as well as our micro SME clients starting out a business, all the way to very successful listed JSE entities that operate at the top end of our corporate bank. We want to make sure that we are relevant, understand their needs, and position our offerings in the context of client needs. So, I suppose then that brings to the next big thing which is the thing that all of us are grappling with, and which is where we'd like to continue to set ourselves apart from our peer group, is digitization. And I think digitization is a very important thing to maybe just spend a few minutes on. Certainly, one of the challenges is FNB heading towards a digital-only bank, and are we going to cut out branches, and are we going to cut out people? Because as more and more people use apps and online banking, etc., is there less need for people? We're very passionate about the fact that money by its nature is very emotional. And, if you look at all of the life decisions that people go through or businesses go through, you know, whether it's first job, first children, getting married, getting divorced, planning for retirement, planning for holidays, you know, starting a business, you know, lending to solve for buying your first home, etc. You know, these are very emotional decisions, and we're passionate about the concept of digital when you want it, human when you need it. So we're really trying to get the best of both worlds, that we allow the convenience of digital access to get things done quickly and sort of solve for your day-to-day needs, but also trying to reposition our client-facing frontline staff to be more advisory in nature, to help clients with those life events, you know, and be there to help them, guide them through those life events of either, you know, whether they're positive or negative. You know, I mean, if you look at COVID and the amount of people that have lost their jobs and what that means for their income and their commitments and how we can help them manage through these tough times, you know, we try to differentiate on, you know, where life happens to people, as you know, as opposed to they are serial defaulters, where they are actually trying to just not honor their commitments, and have very different approaches to where events have happened to people outside of their control versus where it's been in their control and they haven't been effective in managing their affairs. And I mean, I suppose one of the other big things that as a bank we're trying to reposition is not to be a bank, but to be a financial services provider, which is, you know, I mean, traditionally banks have been very good at facilitating money in and out of accounts and giving credit, but not necessarily understanding, are people saving effectively? Are they solving for their short-term savings needs? Are they building financial resilience to take the shocks like COVID presented all of us, as well as build long-term financial independence? You know, that has sort of been the realm of independent financial advisors, insurance companies, asset managers, but increasingly with the power of data and the power of platforms, how banks reposition themselves because they have such rich understanding of clients' activity. How do they use that to help clients navigate life better? You know, I mean, understand how they should, the basics of spend less than you earn, have an emergency savings, protect your family and your assets, start to save and build long-term financial independence so that you can retire independently and or do the things in your later years that you always wanted to do. So we, you know, there's this concept of money being at the heart of many decisions and how we are relevant, not just to actually facilitate the transaction, but to help the decision making. You know, I mean, our navigate on our app we call our NAV home, NAV car, NAV money, NAV wellness, which are really trying to understand how we actually be part of the pre and the post financial transaction. You know, I mean, you don't wake up in the morning saying I need a mortgage. You wake up in the morning saying, you know what, the kitchen's too small, or we need a pool, or the kids are growing up and we need a bigger house. Either renovate the house or buy a new home. How do we facilitate understanding what you are able to afford, and how do we facilitate you actually having access to what types of homes you can afford in the areas you're looking for, and then facilitate the process of getting you out of your home and into the new home, as just an example of how we're foreseeing the role of FNB in our clients' lives, whether it's on their individual side or on their business side. And increasingly, we're also seeing that, you know, I mean, just as corporate South Africa, you know, is shedding jobs, and you know, the notion that, you know, people earn a salary for the rest of their life, we're increasingly seeing, even in the retail bank, that more and more people are starting side hustles. They actually starting a business on the side to augment income, or in fact, they're starting to migrate out of formal employment into self-employment. So this convergence between retail and business banking and helping clients navigate how they, you know, move from being formally employed to being you know, running their own business and navigate that side of the journey as well. We see something that will accelerate over the next few years as we become that trusted partner to help clients manage their money, both in their personal and their business activity. Obviously, underpinning all of this is a very successful rewards program. This year, our eBucks program, which is at the heart of our FNB. You know, typically when you think FNB, you think eBucks and you think our digital platforms, but you know, eBucks is going to be 20 years this year, even despite the tough COVID impacts on our business. You know, I mean, we still paid out over 2 billion rand in rewards to our customers in the financial year that just finished in June, and that is, you know, we believe that we want to reward clients for being loyal to our solutions, and to also for the behavior around how they manage their affairs. And we continue to see that the combination of being this trusted money manager, rewarding effectively, and helping people navigate the life events that we all go through will be key to, you know, sustaining and growing our brand further as we take our business forward. I mean, I've sort of mentioned quite a few different concepts there. Maybe if I can just stop there and see if there's any specific questions there or anything you'd like me to elaborate on.
Thanks, Raj. No, that's incredibly comprehensive. And I think just to comment that certainly at the IAB, when our members come to us about digital marketing transformation, one tends to lean in more to the efficiencies and cost, and one can sometimes neglect the importance of the culture of the business, current and sort of the ambition of the culture to manage that kind of transition. I know you speak to a much larger digitization process in terms of the full company, but I think either way, I just completely resonate with culture and people, the people in the company being a vital part of that. And then obviously, you know, in terms of digitization, the software that supports that. So those two critical factors sort of hugging, I suppose, the whole process in order to take it forward. And I think a lot of companies can forget those two vital pieces right from the beginning. And if they're not in hand, sort of makes the whole process a lot, well, actually impossible. And I think, you know, some brands also speak to client centricity or understanding customer. And I think, you know, I think FNB obviously does that incredibly well. And in all our Kantar talks, you know, this being our 14th one, it has come down to really the agility and I suppose during COVID, an even faster ability to understand the consumer in these changing times. And I wondered if, you know, you speak to the milestones that banking and certainly FNB looks to support their customers through. Do you think during COVID that these milestones were expedited, or did they slow down? I mean, a lot of people had to put big decisions on hold, but potentially other decisions being expedited in terms of home renovation or the side hustle. I don't know if you're able to comment on that in terms of.
No, I mean, yes, yeah, thanks. I mean, certainly, I think, you know, what we saw through COVID was that people, I think, you know, I mean, when people realized the impact that it had, and also the challenges that we have in terms of, one of the challenges of South Africa is this, you know, consumerism, you know, bias, where we have about worrying about today and spending for today rather than thinking about the medium and the long term. I think, I suppose, COVID, when we start to see that, you know, we have to approach every aspect of our life differently, from the environment to our health to our money management affairs, we certainly saw a lot more clients wanting to talk about the medium and the long term. You know, have they saved enough? Have they got a will in place? Are their financial affairs in order? You know, I mean, are they thinking about long-term financial resilience? I mean, and one of the benefits of effectively operating largely as a virtual business, because, I mean, end of the day, our solutions are largely digital. You know, I mean, other than a physical card or a physical, and you know, checks is finally going to be you know, exited from the South African banking system by end of this calendar year. So we just physically, the only physical things of our business model is cash and cards. And I mean, we very much therefore able to operate virtually. And you know, our bankers and our client-facing staff were actually having very meaningful discussions with clients about starting to think about more medium and long term, and not just in the private bank or the business bank, but also in the retail bank. You know, I mean, I think it's whether you a middle market customer having to solve for your needs around, you know, how you create more financial resiliency and independence, or whether it's a private bank customer worrying about, you know, offshoring of assets, etc. the discussions have tended to move from short-term thinking to medium to long-term thinking. And then digitization has also been a big factor. I mean, we saw in the last 6 months, 28% increase in number of clients using our digital channels, specifically our app. So a balance of digitization growth, but also people starting to take, money matters more seriously and thinking about the medium and long term, which really helps us in terms of our positioning of wanting to be that trusted money manager. And as we figure out how we come out of COVID and navigate the years ahead as that the challenges that the South African economy faces.
Thank you, Raj. We've
But
just
I mean, just a specific, just one specific positive point as well. Apart from the media that we put out, that if you look at clients earning between 10 and 60,000 rand income, our August income into bank accounts is effectively back to levels for salaried people that it was in February, which is, I suppose, a positive sign that the 90% plus economy is there. And what was an interesting stat as well is that July was actually a record month for home loan applications. I think people had either a pent-up demand, or because of work from home becoming such a big reality, people realizing they need to upgrade their homes or consider a very different approach to the home as it becomes the primary means of your work and your life and your personal activity.
Yeah, it actually is interesting to watch how spend will have shifted. So you may see a lot of spend declining in office areas, but then, like you say, the home loans going up, and to understand those insights, I think, is incredibly valuable in terms of human behavior. I've just had a question here for you, Raj. How do you or they continue to differentiate with all the digital newcomers challenging your innovation and digital credentials? Is that something that you?
Yeah, I think certainly from our perspective, and certainly we welcome competition, and we welcome the new banks and the new entrants that have come and are planning to come into the market. I think it's healthy. If you look at any country in the world where there's more competition, it means consumers win or businesses win, and we certainly welcome that. And it just pushes us to keep outperforming and keep innovating and trying to continue to do better than what our peers are doing. And one of the challenges of a lot of the of the new competitors is they have very narrow offerings. Even Discovery, which arguably has a more broad offering, is still quite narrow. But fundamentally, we do want them to succeed. I think we'd rather have new competitors succeed, like Capitec has been a massive success in the South African banking system over the last 10 years, because that is better than banks being regulated and pricing being regulated by regulators because they don't see enough competition. If you look at what's happened to bank fees over the last 10 years, you can see that competition has had the effect in making sure that customers are getting value for the services they're paying for.
Fantastic. Thank you, Raj. And just sort of an influx of messages coming through on the chat around happy FNB bankers. So that's also good. And just a big thank you for all the insights that you've shared. And I think certainly tantamount to your success in the Kantar BrandZ report. We have just run out of time in terms of questions. I don't know, Stina, Natalie, and Raj, if there was anything you would like to share before we close off today. Stina, perhaps if there's anything you'd like to add to Raj's comments or the talks.
Paula, no, thank you. I think you said somebody had a question around consumer packaged good brands that have supported consumers emotionally.
Yes. Thank you.
And I think a good example of that would be Nike. So if you think about how Nike has supported Caster Semenya, I know there's also a FirstRand Group connection with Caster Semenya, but Nike and taking the knee, I think they've really amplified relevant issues to support consumers emotionally. So there's a good example just to answer that question.
Oh, thank
and
you.
then if anybody has any other questions, they're welcome to contact us at Kantar, obviously.
Fantastic. We'll include those details in the thank you mailer. So if anyone has got more questions, please do shoot those through via email. Natalie, anything from your side? I know we've covered a lot of ground.
Yes, we have, and I think we've run out of time. So,
Okay.
so no, I guess nothing from my side. Just again, a thank you for having us. And I think just to build on to Raj, again, just emphasizing the importance of driving differentiation, especially in South Africa, you know, doing that through innovation, being different, being disruptive, and just disrupting the status quo. And I think digital, tech, social, you know, those are all the ways that we can do it. So thank you.
Thanks, Natalie. And Raj, thank you so much for joining us today. I know your schedule is incredibly jam-packed, so your insights and your five, I think you had 5 or 6 key core pillars that you shared with us today that sort of were incredibly helpful and interesting to listen to. I don't know if there's anything else you'd like to add before we say goodbye to our wonderful guests.
Great. Thanks very much again. Just thanks for the opportunity, and we're truly humbled by the recognition. But you know, we still know that we have a lot to do to win, you know, this client-centric money management game. And yeah, we look forward to continuing that journey. Thank you very much.
Thanks, Raj. Thanks so much, Natalie, Stina, Raj, for joining us, to FNB and the full team Kantar. Yeah, a fantastic session today for our 14th episode. And to everyone who's on the line, thank you. We'll be sharing all the content that includes the presentation, the Zoom video webinar recording, as well as a fantastic article from Lee at Team Kantar that summarizes all the key takeouts. So we look forward to sharing that with you tomorrow. Have a fantastic Wednesday and an excellent rest of the week, and happy 1 October for tomorrow. All the best. Bye.